hey, I have a confession. I hate taxes. I'm not good at it. I'm not good at records. And then over time, we change them. They start to embrace taxes when they see the power.
To me, this is such a huge benefit of real estate and specifically short-term rentals, because if you're making $200,000, $300,000 in your W-2 and you have a property that you can depreciate and offset that 200 grand, it's going to save you so much in taxes. If you don't understand this, you're missing a huge piece of this game. What's going on, STR Nation? Welcome back to another episode of the Short-Term Rental Secrets Podcast. I'm your host, Mike Shogren, here as always with my main man and brother from another mother, Mr. Emmanuel Pani. Happy holidays, E.
Happy holidays, my brother. If you're listening to this on Monday, I am on my way to Denver, Colorado to go spend my first Christmas. So my sister is 27, recently got married. And so now that I am no longer married, she put her little stake in the sand and she's like, well, I am claiming Christmas. And so me and my mom are both heading to Colorado for the first year in which Martina is going to be hosting the holiday. So I'm super excited to, one, not have to clean up anything, not have to cook anything. So that's great because you have a lot of pride in having people over until they leave. And then you're like, oh my God, I cannot throw all these dishes away because I would not have no dishes left. So I need to actually wash everything. So super grateful. Are you guys hanging out at the house? People coming over? What's your guys' plan?
We are hosting. So we're kind of the spot now where we host every holiday, but I will say I'll give the family credit. Everybody's good about helping do all the dishes and clean up before they leave and divvy up leftovers and all that stuff. So the only burden is on the front end and I am useless. So I'm just watching the kids and getting the hell out of the way, but letting Kristen and the moms get in there and just do their thing and whip everything up, and then I just show up and eat. So I'm looking forward to it, man. There's nothing like Christmas morning when you've got little kids. There's just something super special about it, and yeah, I love it every time. It's awesome. So I'm looking forward to it.
Yeah, I'm excited.
Completely different direction. We've got a very special guest today, as it is pretty much year end at this point. We got another week. We wanted to bring on a very special guest today. We've got Amanda Hahn from Keystone CPA. Amanda is one of the foremost experts on taxes for the real estate space in general. I mean, she's Brendan Turner CPA. She's CPAs for a lot of thought leaders in the space, and she's super knowledgeable, and she's just an awesome human. She's got a great personality. She's super fun, and she really knows her stuff. And so what we wanted to cover, because I know taxes for a lot of people automatically bring up a sense of anxiety, and I want to calm you right now, because this episode, in my opinion, really helps explain certain things in layman's terms to just give you the lay of the land and empower you to, one, understand how taxes work for you in real estate, and then also, if you're not thrilled with your current CPA, what to look for when you're hiring somebody to help you with your taxes. And it doesn't need to be stressful when you have the right advisor and you have the right process and understanding in place. And so I know it's not the sexiest topic, but in my opinion, it's one of the best benefits of owning real estate are the tax benefits, right? So we covered, all the way from the beginning of understanding what is the short-term rental tax loophole, because there is a tax loophole specifically for short-term rentals. And there's so many misconceptions and false information out on the interwebs and in Facebook groups and everything else of people just saying stuff that is just not true. And so Amanda covers exactly what is that and how do you qualify for that. Then we dove into just high level, what is depreciation, right? If you're new or, you've never really fully understood, what is depreciation? We talk about it as a huge benefit of real estate. We just cover what is it and how do we use it? And then how do we accelerate it, through something called bonus depreciation and accelerated depreciation. And she explained it in such a clear, high level that anybody can understand and just make this information a lot more accessible. And then E, you were asking a lot of really good questions at the end of this one on how to find a good CPA, right? Because it's like anything, it's like finding a really good investor-friendly real estate agent, right? They're few and far between, but how do you navigate those waters?
Yeah. And she gave us a couple questions that you can ask immediately to kind of weed out the people, so you're not spending too much time. Another thing that was awesome that she talked about when it comes to taxes in general is the understanding that it is not a sexy topic until you understand it. Once you understand it and you really understand the benefits of it, she used the example that now Brandon talks about it all the time because he now understands how useful it is, and then it made him a more sexy topic for him to talk about. The other thing that I asked here on a more fun, lighter kind of topic was the concept of income shifting. And so how you can use family members and people to help you in your business, including your kids, to offset some of that money. And so I've heard a lot of it about it. And again, Amanda, and that to me is the true metric of professional, is how good are you at explaining something to me that I may or may not have heard about a lot, where I leave that conversation with a whole other picture and a much clearer picture of what you just explained to me so that I can explain it to somebody else.
And one last thing before we get into the episode, a huge thank you from E and I for listening to the show. And we want to wish you a very Merry Christmas and Happy Holidays to you and your family. Hope that you have an amazing day. And let's get into this one with Amanda. All right, we've got Amanda Hahn in the house. Amanda, how you doing?
I am doing well. Excited to be here.
Thank you for being here. We were able to squeeze you in for your last podcast of the year.
Yes, yes. I mean, there's still a little bit of time left before the end of the year. So I think it's really, really important to do some year-end planning, before we really sign off for 2024.
100%, 100%. And for the folks that don't know you, clearly you haven't been too active in the real estate community, but why don't you give us your background? And I'd love to hear how you got into real estate too, because I know you're an active investor as well. So
Yeah. Well, my name is Amanda Hahn, and my husband Matt and I own a CPA firm called Keystone CPA. And what we're known for is we work with real estate investors nationwide on how to use real estate to minimize taxes. And for me specifically, I actually am the third generation of real estate investors. So my grandparents invested in real estate when they immigrated to the U.S. My parents dabbled in real estate a little bit here and there. Growing up, I just always told myself I never wanted to be a landlord because I grew up living in the condo community where my grandparents were the landlord, and they were like very hands-on investors who, they didn't really speak good English. So at 8 years old, I had to go with them to collect rents, like back rents from tenants and, do some of the repairs and stuff. So I was always like, I want to get a corporate job. I want to sit in an office, and I didn't want to have anything to do with real estate. But my husband actually read this little known book called Rich Dad Poor Dad. You should Google it. He decided that, real estate is probably something that we should get into for wealth building. And it just so happened that my career as a CPA, I worked mainly in the real estate sector. So I specialized in working with real estate investors. So for us, it was a natural transition to how do we just go over to the other side instead of just advising people about real estate taxes? How do we then get into real estate investing? But nonetheless, I have to say my first deal was probably one of the scariest things I ever had to do. Because it's like, how could a CPA know to invest in real estate? So I had a lot of the same fears that I think maybe some of our audience members may have had with their first property.
So how long ago was that first deal for you?
Oh my gosh. So our first investment property was probably around 2006 or 7, right before the big real estate crash. And in fact, my husband and I decided to quit our jobs and open up Keystone CPA to specialize in real estate. And then shortly thereafter, the real estate market basically came to a halt.
Wow. Nothing like jumping in and getting punched in the face, but that's awesome. That is awesome.
Yeah, I mean, we really second guess ourselves too, like how risky to leave the comfort of a W-2 job to then get into real estate. And then, I think specializing in something as a CPA itself is pretty scary, but also to say I loudly declare I'm going to be a real estate CPA and just kind of getting an understanding that our clients didn't have money, everything was going through foreclosures. But I think we learned a lot. There's nothing like starting a business in an industry that was going through some very extreme financial hurdles. So I think if you can survive that, you can survive any real estate market cycle, really.
It's interesting. I left my corporate job as a CPA, actually, January 1st, 2020. and just getting my feet under me. And then boom, COVID hit, and everybody's like, "You got to go get a job." I'm like, I will figure it out. I am not doing it.
Yeah.
So I can relate. Luckily, COVID didn't last as long as that whole 2008 issue. But
Yeah, yeah. I guess, yeah, we have very similar stories. I think even for us, when COVID hit, was kind of a lot of like, people not paying rents, obviously, right? Because the tenants not, we think they were not going to be able to pay rents. But I mean, as you like now in hindsight, 2020, what a great year to have purchased a lot of real estate.
yeah, hindsight's 2020. One of the things that I want to talk about, especially for folks that are unaware of it, is kind of jumping into the tax side with short-term rentals specifically. Like there's a very unique piece of the tax code that people jumped into the game, especially, post-COVID. A lot of high earning W-2s started learning about this piece in the tax code around short-term rentals and how you can offset part of your active income during this different loophole. So could you explain what this tax situation is for those that are unaware in the tax code for us?
Yeah, of course. So I think to take a step back is really important for people to understand when we talk about tax losses. It's usually the loss from tax benefits or tax strategies from things like maximizing your write-offs and depreciation, right? So we're not saying like losing money. We're just saying strategically create some tax losses from your real estate activities. And when it comes to rental real estate, for most rental properties, whether it's a long-term rental or midterm rental, single-family commercial real estate, usually the rules are that if you make over $150,000 of income in total, that includes like W-2 and other businesses. So if you have over 150,000 of income, then rental losses are generally considered passive losses, which just means that they can offset taxes from your passive income, but not from your active income, like W-2 or a business you operate. Unless if you're a real estate professional. And for most people who work full time, it's difficult to be a real estate professional because one of the criteria is you have to have earned more hours in real estate than your job. So if you're working 2,000 hours a year at your job, you got to have more than 2,000 in real estate to be a real estate professional, and then be able to use those rental tax benefits against W-2 income. The reason we call it a short-term rental loophole is that when we're talking about short-term rental investments, if you strategically create tax losses, you can potentially use it to offset your W-2 income, even though real estate is sort of just a side hustle for you. And the reason for that is the IRS looks at short-term rentals a little bit differently than long-term and mid-term rentals. And you can use the losses as long as you meet what is called material participation hours. And so what that means is, we have a lot of clients and, investors, like probably people you work with too, that have a W-2 job. They have no intention of quitting. Maybe they're in a professional career. They just really love it. But they also want to build wealth through real estate, and they want to be able to use those rental tax benefits against W-2.
So Amanda, on that, right? So you said to become a real estate professional under the tax law, you have to work more hours in real estate than you did on your short-term rentals. So if you're married and your spouse maybe doesn't work a full-time job, is there a minimum amount of hours required where they're going to compare it to? So let's say somebody just works some kind of small business where they're only working maybe 10 hours a month.
Mm-hmm. So yeah, I just want to clarify first. So if you invest, the term real estate professional, like you said, there's a bunch of different requirements, but one of which is more hours in real estate than your job. And that's really difficult for people to overcome because you're working over 2,000 hours a year at your job, right? But for short-term rentals, we don't care about real estate professional at all. You just have to meet material participation. And so it's interesting because I think the short-term rental loophole is probably one of the top most common mistakes we see from investors all the way to CPAs. And so if you're a short-term rental investor, here's a trick that you can do, okay? People always asking me like, how do I know if my CPA is good if they understand real estate? So you can trick them. You can ask them like, okay, for my short-term rentals, how many hours do I need to have to be a real estate professional? If they talk about real estate professional, that's a good sign that they don't know what they're talking about. Because for short-term rentals, again, you don't have to be a real estate professional. We don't care. We don't care how many hours you work at your job. We don't care about any of that. We just care that you meet material participation hours. And so to answer your question, what are material participation hours? There's a couple different ways to qualify. The three most common ones is the first one is you have at least 500 hours on your short-term rentals. So if you bought a property, and if you're married, you and your spouse have at least 500 hours in the short-term rentals, that's the end of the story. You can use that loss against W-2 income.
Okay.
And I don't care how many hours you work at a job. I don't care what you do for your job. None of that matters. If you don't have 500 hours, you can also use this loophole if you have at least 100 hours on your short-term rentals and nobody else has more time than you. So that would be like, E has 150 hours with the short-term rentals and your cleaning crew only has 80, your repair guys only had 20. So no single other person had more hours than you. You can always use that same loophole. And the third one is that you have more hours than everybody else combined. So that would be where you have 200 hours and everybody added up only has 150. You can also use that. So any one of those three like common ones allows you to use the losses against W-2 income. So just keep in mind, I didn't say anything about your hours at W-2 because I don't really care in short.
No, yeah. I love that. And I think this is probably the best I've ever heard this kind of like explained. And so let's say that somebody listens to the show now. It's the 23rd of December on Monday, right? More or less. I think that's the day. They have a property and they're like, okay, can we squeeze this in? Is there a way for them to, like, what do you ask? Do you ask for me to quantify the hours that I spent? What do I need to give you in order to make your life easier and myself safe in case the IRS comes back and is like, well, show me.
Mm-hmm. The short-term loophole is actually really great for year end. I know we're super close, right, to the end of the year, but it's actually a strategy a lot of our clients do is they buy properties in like the third and fourth quarter because then they can rack up a lot of hours getting the property up, ready, staging, self-manage it, and be able to, use that for right now. Now, if you're going to buy a property tomorrow, probably not enough time because in order for you to use the benefit, the property has to be placed in service, which usually means it's already furnished and people checking in and out right before year end. But if you have an existing property already that's a short-term rental, then yeah, absolutely. I would say let's make sure you do as much as you can, be as hands-on as you can for the remainder of the year if you are close to qualifying for one of those three material participation hours. So I always tell people, when you're a property owner, you're in full control over how much or how little you do with respect to your properties. But you can be smart about it and just make sure you earn the hours correctly.
Gotcha. So the reason I want to bring this up too, and there was a misconception that I had years ago as well, and we could talk about cost segregation studies here in a second to simplify that, to make sure people understand what we're talking about. But you don't have to have the cost seg done by the end of the year, right? So if somebody's thinking in the back of their mind, hey, I want to accelerate my depreciation, we'll rewind in a second here and explain what we're talking about. But if I want to accelerate that by the end of the year, it actually doesn't have to be done by the end of the year. It just has to be done before you file your taxes.
Correct. Yes. Yeah. And it's unfortunate because I think there are some cost segregation firms out there sending mixed messages like, oh, you have to do it before year end. But you're right. With respect to year end planning, a couple of things we look at is, earn your hours, right? That's first and foremost. Or I guess first and foremost, you have to have short-term rental and it has to be placed in service. So it's not just vacant. It's like furnished and people are checked in and out at least once or twice. And once you have a short-term rental in service, then it's making sure you earn the hours. Those are really the two key things. Yeah, the cost segregation, like you said, Michael, that could be done anytime before you file your taxes.
So let's just quickly describe depreciation and then accelerated depreciation. And I don't want to go too deep because I know some people's eyes are going to roll back like I have no idea what they're talking about. But to me, this is such, and I get it, I'm a geek, I'm a CPA, but like to me, this is such a huge benefit of real estate and specifically short-term rentals, because if you're making $200,000, $300,000 in your W-2 and you have a property that you can depreciate and offset that 200 grand, it's going to save you so much in taxes that if you don't understand this, like you're missing a huge piece of this game, because that 40 or 50 or 70,000 that you're going to give to Uncle Sam, you could use that towards another down payment for another property next year, right? And so a lot of high earning W-2 earners that I've spoken to over the years, it's just part of their cadence, to Amanda's point, of like come Q3, Q4, they're looking for that next big purchase and they're just buying one property a year. They've built up their portfolio over time and they're making cash flow, but more importantly, like they're offsetting that W-2 income. right? So
Yeah.
let's just take a quick minute to talk about what is depreciation and then what is this accelerated depreciation and cost segs.
Yeah, I mean, depreciation basically, so when we own rental real estate, the IRS or the tax code says, we have a building and the building itself will have wear and tear over time. It kind of deteriorates, right? And as a result, then you get to take depreciation. So basically, it's a paper write-off on the purchase price of the building because of this assumed wear and tear. And this is allowed for investors regardless of what the property is actually doing in terms of market value. So what we frequently see is, you buy a property for $100,000, it appreciates in real life, but for tax purposes, we show it as depreciating. And so we have this paper write-off that we take year after year. Traditionally, residential properties, we take it over 27 and a half years. So whatever the building purchases, we divided that over 27 and a half, and that's how much write-off you get, a little by little per year. Cost segregation is basically taking this depreciation benefit and sort of supercharging it. And it's saying instead of just me having the building over 27 and a half years, I'm going to break out the components of the building. It's going to be made up of specialty plumbing, specialty electrical, certain cabinetries and blinds and flooring and fixtures. And by breaking those out, but by the way, you don't have to do it. It's done by your cost segregation firm or other experts who do it. You just have to buy the property, right? So then your tax team will break out the components, and the result is that you're just going to get a much larger depreciation in the earlier years you own the property. And so I think what you're saying, Michael, is something we see all the time. Let's say you're a doctor, you make $500,000 a year, you buy one or two short-term rentals with cost segregation, and obviously you get to depreciate like all the furnishings too, but that you put into the property, the supplies. And so maybe with one or two rentals, you have a $200,000 tax loss from this depreciation. And so if you're, close to 50% between federal and state taxes, that might be, like 150,000, right? If we have 100,000 of depreciation, maybe a $50,000 in terms of tax savings. And what people do then is they take that 50,000 taxes saved and they reinvest that into another short-term rental, kind of rinse and repeat where you can build wealth and also save on taxes year after year.
So I love that you brought that up, and Mike, that's a great question. We hear a lot in the real estate space lately, people going, I'm going to do a syndication. And I know a lot of the times people that do syndication, then use cost segregation as part of their pitch to investors, right? So they're like, hey, are you a big W-2 earner? Invest in my syndication. We do the cost segregation. This is going to help you with your taxes. Help people understand the legitimacy of that as a statement. So if somebody that listens to the show has had that pitch, for them to understand, okay, it does that check. And then I would also love for you to talk about the other side of that coin, meaning if an operator that is listening to this wants to do a real estate syndication, how can he speak about it in a way that he sounds educated in case, for example, somebody brings Amanda in a meeting with him. It's like, Amanda, come listen to this guy. He's pitching me on a syndication. Help them at least not put their foot in their mouth.
Yeah, I mean, we have a lot of clients who do syndications. And first off, I want to say the term syndication itself is sort of a generic term in the tax world. Syndication just kind of means that, I'm pulling investors' money together. I'm in charge of kind of the operations and you'll get a K-1, right? And so syndication, like for me as an advisor, my client says, I want to invest in a syndication. What's the tax impact of it? I have questions for the sponsors, like, well, what is the syndication involved in? Are we doing multifamily? Are we doing self-storage? Is it a short-term rental? Is it a note, right? Are we just making loans? And the reason that's important is because how I benefit as a passive investor, when do I get the benefit? A lot of times it's dependent upon what is that asset in the syndication. So you're right. Unfortunately, there are syndicators out there who are not clear in their messaging, and they say, hey, invest in my apartment and you're going to, save $100,000 in taxes. Hopefully, they have some kind of a CYA in that messaging that says, consult with your tax advisor because, a syndicator cannot guarantee how you are able to utilize it. So, if you're an investor, you always want to talk to your CPA about what are the implications before making that investment. And I would say the vast majority of the time, if you're investing passively in a syndication, Unless if you are a real estate professional, most of those losses are going to be passive to you, which means it's not offsetting your W-2 income. It's probably just offsetting income from other rentals or other passive sources. Now, the question that would be interesting is, what if I have a short-term rental syndication? And I am using the short-term rental loophole myself with my own short-term rentals. Can that syndication investment then also offset W-2 or not? I haven't seen, well, first off, we didn't have any clients so far that's done short-term rental syndication. So we haven't really delved into that in depth, but I think that's probably a question that will have to be answered at some point in time. There is something that allows us to do what's called a grouping election. So in the normal sense, it's like I have a short-term rental here and 2 more out of state. I can group them together so that as long as I have 500 hours, I can use the losses across my portfolio. That might be a possibility with respect to syndications as well. But again, this space is very new that I've not really seen any court cases to specifically say this is allowed or not allowed.
So somebody will bite the bullet and get that first court case, and then we'll have some data to go off of.
Yeah, I don't know that you have to go through court, but it's just, I think if we did have a client that was involved in that, we would do, like a more in-depth research to see like, okay, what are some other fact patterns we can use to support this position. I think it, looks good. I just don't think I can say it's fail proof yet, that like for sure it works until we really look into it.
Mm-hmm. So I'm curious on your take. Where do you think we're going in 2025 now that the election's done with bonus depreciation? In your opinion?
Yes, we're always monitoring what's coming out of DC, just in terms of what the possibilities are. I think with the election results, things are looking really good in terms of tax benefits for real estate in general, right? Because obviously, Trump is a real estate investor. Republicans typically are more pro-business, for real estate. And so I think from a high-level perspective, the outlook on real estate benefits and then also bonus depreciation looks really good. But now what we're looking at is the timing of it, because I think a lot of our clients have questions on, okay, well, if 100% bonus does come back, when is it going to come back? What is the effective date? And we were really hoping that it would be retroactive to January 2024, which means everything you bought in 24 in service potentially gets 100% bonus. I was at a real estate conference last week, and a lot of people much smarter than me that are actually in the hallways of DC listening to what's going on. And they've said that the latest signal has been when the administration takes over, the new administration takes over, they're probably going to focus on border control first in the first 100-day efforts, which is sort of a bad thing because that sort of means maybe they're not looking at taxes in the first 100 days. And I would have to imagine that if they don't take action right away in the first 100 days on tax changes, they probably won't do it retroactive to 2024 because people have to file tax returns by March and by April. So if the changes come out thereafter, probably, impractical to have a bunch of people file amended tax returns. But that is my guess. And
would you suggest for people wait in filing their taxes to see how the first 100 days go? Like, how are you playing that now?
Yeah, great question. Most of our clients file extensions anyways, just because they're waiting on K1s or businesses are still, things are still going on. So 2024, for example, we did intentionally have a lot of people go on extension. I don't know how you guys follow tax policy, but 24, we had the same issue. Was it going to come back to 2023 or not? So we kind of waited and waited. Oh, but also too, the benefit of going on extensions is it allows us to do what's called multi-year tax planning. So in March, I probably don't know what 25 looks like yet, but by September and October, I have a really good idea what 2025 looks like. So sometimes it allows me to strategize on when should I do bonus depreciation? How should I file my returns like get lowest tax rate across 2 years?
Mm-hmm.
So that's just another reason. But just so you know, I think when they do tax change, it's not going to be based on the filing date. It's going to be based on whatever they say is the effective date. So yes, if we think they will make it retroactive to 2024, but I don't really know if that'll happen yet, I'd probably suggest clients go on extension. But if I feel like it's probably not going to be retroactive, maybe the earliest might be January 2025 as the effective date, then I will probably have my clients file especially if they're anticipating a big refund, right? We don't want to leave that risk longer than it has to.
For sure. I love that. And so, Amanda, question for you. If somebody is listening to the show and is like, hey, like I have realized that maybe I don't know how other people are in the world, but for example, my accountant for the longest time was my dad's accountant, right? And you just go into like, who do you know that you love and trust and who are their accountants? And then those are the people that you choose. So if you listen to this show and you're like, I think I need a new accountant because Amanda's been saying things that I had never heard and I've been a real estate investor now for a little while. How do you find a good CPA and what are some of your like red flag questions that would be an easy, just like, nope, this guy is off or this girl is off the list?
Well, I think I shared one earlier, right? If you're investing in short-term rentals, your CPA starts talking about real estate professional or how many hours you're working at your job. That's like that's the first strike because that is why it's the loophole. We don't talk about real estate professional. I think it's difficult, I have to say, to find a good CPA because accountants in general are not very creative people. So it's hard to find someone who is creative and strategic. And that's really what you're looking for, right? It's because it's not about filing a tax return. It's about how do we do the right things during the year so that by next April, I've done all the right things to legally save on taxes. I think it's, when you're interviewing people, don't ask them like, hey, do you have real estate clients? Because everyone will say yes, even if they have like one client who turned their home into a rental. You just want to ask more powerful questions. Like, what do you think about the short-term rental loophole? And just let them talk about it more. Or a really good one I always tell people to ask is like, what are your successful clients doing today in real estate? And that's a really powerful question because it gives you insight into who they define or what kind of person they define as a successful client. And is that somebody that you ideally want to get to? Because if their answer is like, oh, well, I have this Mary and John and they have 3 rentals and they make a lot of money, then you have an idea that if that's their most successful real estate client, this is probably not where you want to be because you're already there. You're already like above that, right? Beyond that. So those are the things. But I would have to say like, it's not about who's filing your tax return. It's about the tax planning and making sure you're doing the right things during the year too, so that by next April, you can file the right taxes.
Yeah. I'd love to switch gears for 2 seconds because we do get a lot of listeners that are just managing other people's short-term rentals, right? Co-hosting. And you're obviously not going to get depreciation, but what are some other things that they should be thinking about and making sure that they have their ducks in a row before year end for different write-offs that they can take? Because people ask us all the time of like, hey, I don't own anything yet, but I'm managing. Like, what does that mean? Do I get anything?
Yeah. I mean, co-hosting really, if you think about it, it's just property management, right? I'm sort of managing the property for other people. And so when it comes to tax law, it's the same as any other management company or any other business that you're running, like a CPA firm. And so, yeah, we don't get depreciation, but we get to write off all the same things. So depending on what you're paying for with respect to the real estate piece of it, those are all legitimate write-offs for, people who are treating it as an active business. One way to reduce taxes is maybe through retirement contributions. So if you don't have full-time employees, you can potentially open and contribute to solo 401k, and that could reduce your taxes, pretty significantly. Also, from an entity structuring perspective too, if you're co-hosting, that's generally active income. So maybe having an S corporation might be better than, personal name or just in a single member LLC. So there's different things you can do. Of course, our favorite is like, hey, if you're co-hosting, but you also have your own portfolio of short-term rentals and you meet the hours of material participation, then you can use, rental loss against your co-hosting income as well. So a lot of fun things that people who are doing co-hosting could strategize on before year end.
Interesting. I have a little bit of a wacky question. And it's wacky because it's not necessarily related to this specific, but it's about taxes. I was doing a coaching call with somebody, and they mentioned that one of the goals that they have for the year, they listened to another podcast about hiring their kids to have a tax write-off in their thing. I don't have kids, but I'm like, okay, that would go on the con side of like, should I have kids? Yes or no? If I can salary them and write them off later, I'm like, oh, maybe a little one would be more worth it now, right? So walk us through that. Is that a real thing? How should people look at that? And Yeah, is that real?
I love it. I've never heard this question asked that way before. Like, should I accelerate having kids so I can write them off?
I mean, I've been in real estate for a long time, so I gotta like rack up all the deductions that I can have.
Yeah. What we call in the tax, we call it income shifting, but it's basically paying kids or other family members to take a tax write-off for it. And this works well. So just so you know, if you don't have kids, you can do the same. If you have like a brother or a cousin that's like you're
Okay.
supporting financially, like, can help out, or even like parents. We have a lot of clients who have aging parents who are retired or semi-retired who can help in real estate. The concept of it is, how can we shift income from our high bracket into someone else in a lower tax bracket, and having them help out, right? So but they do have to help out in the business. So when we talk about hiring kids, a couple of things to keep in mind, what I always tell people is, when we say we're going to hire our kids, we actually have to do all the things that you would do when you hire somebody. So you have to have a job description. You have to pay them a reasonable compensation, and they have to actually do the work, right? So it's not just like, I'm going to verbally say I'm going to hire my kids, but not do anything. You really want to substantiate everything by doing the actual things that you say you're going to do. And of course, we don't want to, who wants to teach their kids to lie, right? Like, hey, Jimmy, I said I was going to pay you. I'm going to write up. I'm not actually going to pay you. Like, that's like really terrible. But with respect to rental real estate, and I think especially for short-term rentals, there's so many opportunities to have your kids help out, whether it's like taking pictures for the ad post or helping you manage like reviews, or, even like guest turnovers, right? Where you
Mm.
have to go. I
Like
mean,
in the
I did that.
yard, give the garbage, like all the little things.
Yeah, exactly.
Okay.
I did that with my grandparents. They were short-term rentals, but my cousin and I, we would go and like paint the walls and clean up. And so many great opportunities. But you do have to make sure you do all the right things, that the kids are at the right age. So like a 2-year-old is not going to help with turnovers, right? But a 12, 13-year-old, absolutely, lots of stuff they can do.
Love it. Cool.
So before we wrap up, I'm curious, because I know us accountants can get a bad rap that we're different people. So I want to learn more about you, Amanda, because one thing I saw, I think it was this year, it was like you and Brandon Turner, a bunch of real estate people. You did some type of like fitness challenge, and I was like, damn, that looked like fun.
So
You guys are like crushing it. It looked like all chiseled up in Maui or something. What was that all about?
yeah. Oh, yeah. So, yeah, Brandon is a client of mine. And in fact, a lot of my clients joined him in this fitness challenge. I think it was like, how, every day we have to have 10,000 steps, work out 3 times a week, and dietary goals. And I found out kind of last minute, I think they already formed the group, and I was like, oh, that's cool. I would like to join. And the one thing, my Achilles heel is like, I don't like to work out. I hate exercising. So I thought, what better way for me to be held accountable than to join a group of clients on a fitness challenge? Because if I fail, that looks really bad for me as an advisor. So it was a lot of fun. I actually posted about it on social media that, behind all these cool pictures of everybody being all like muscular and tanned, there was a lot of daily text messages threatening each other about what we were going to release on social media, because we all knew at the end of the challenge we were all going to be in like workout clothes posted on everyone's social media. And that lingering fear is what kept me going every day that I didn't want to exercise.
Well, it's interesting. E and I met 10 years ago in a mastermind group, and we got put in an accountability group together. And every week we would meet, and there'd be like the carrot and the stick, right? And I don't know if a lot of people know this, but I was talking about getting into real estate for like a year. And then I went to this event, and one of our mentors was like, he gave me some real tough love. And he's like, listen, I don't want to hear you talk anymore about this. Just shut up and either do it or don't. And at the event, I got up on stage and I said, this was in September.
Mm-hmm.
And I said, I am going to close on my first property by the end of the year, or I'm going to eat dog poop on camera and sell my motorcycle. And like literally in front of like 300 people at this event. And to your point, I'm like, I committed in front of all these people. I am going to get this done, like period. And so there's huge power in positive peer pressure, right? You can use it for negative or positive, but get around people that'll support, encourage, and challenge you.
Yeah, for sure. I think it's, I mean, especially for things that are hard, the difficult things, when you make a public commitment like that, it's always in the back of your head. And in the times that you're like afraid or lazy, I think it's the opposite of why. It's the public shaming. People are like, I do it. This is my why. for me, and the exercise was more like, I just didn't want to be publicly shamed. So that was my why.
Either works. We'll do more to avoid pain.
Yeah, yes. Well, if you guys want to do it, you should join. We're going to have another fitness challenge coming up, I think, in February or March.
Okay. All right. I will do that. Awesome. Well, before we get into our last question, I want to acknowledge you and thank you for coming on. I really appreciate it. You're always putting out great information online and just helping a lot of people, because the word tax can just create anxiety and this mystique around it. And if you really work with somebody knowledgeable like yourself that can explain it in layman's terms of like, this is what this means. And there's actually a lot in the code designed to help you, not to hurt you. And if you have the right advisor in your corner, it makes all the difference. And so I wanted to thank you for that. And I wanted to make sure that everybody knows where to find you and all the good stuff that you and Keystone have going on. So where's the best place for people to connect with you and follow you?
Yeah, thank you. And I will say that for most of my clients, when they come to us to start working with my team, they all hate taxes. That's always just like, hey, I have a confession. I hate taxes. I'm not good at it. I'm not good at records. And then over time, we change them. We change them. They start to embrace taxes when they see the power of how it could actually help you to build wealth, help you to grow your investments. And a lot of my clients become known for talking about, like Brandon's one of them. He talks about taxes all the time. Although in the beginning, I was like always afraid, like, what's he saying? Is it right? But I think it's really good for a lot of people to see that shift. My company is called Keystone CPA. So you can go to KeystoneCPA.com. We have a lot of great free resources that you can check out and also tax updates. If you're looking for daily tax tips, the best place to find me is on Instagram as Amanda Han CPA. And if you have an appetite for a more in-depth tax content that you just really want to learn, my YouTube channel is also Amanda Han CPA.
Love it. Well, the last question that we ask all of our guests is, what is your number one secret to success?
My gosh, my number one secret to success. Gosh, I think for me, it's about just taking action. I'm a big believer of, if you think of an idea, you want to do something, just do it. And all the details and the what ifs will sort of be worked out as you implement towards that goal. I know that's very different for CPAs because accountants usually are like, I need all the facts before I even take step one. But I feel like that kind of is what differentiates me from most accountants. I feel like for me, that's sort of been the secret. And also just doing it in spite of fear, just take action, even though you don't have all the answers, even though you might be kind of scared. But only way to find out is to do it.
I mean, this was the most enjoyable conversation I've ever had with an accountant. Hats off to you.
I don't know how I feel about that, but
You're my close accountant.
But not an active accountant, let's say, somebody that is actively an accountant. And that's because you're not seeing my numbers. So I think that also helps. My one looks into my soul every time I meet with him. And I'm like, I don't like this, but it was great having you on.
Well, Amanda, thank you so much. We really appreciate it. And for the listeners out there, hopefully you enjoyed this one. If you are looking for an accountant, especially for your short-term rental or real estate business, Amanda is one of the most reputable CPAs out there. So please look into her, reach out to her and her team. And I'm more than confident that they'll take good care of you guys. So with that being said, hope you have an amazing Christmas. Happy holidays, everybody. We will talk to you soon.
Hey, STR Nation, if you enjoyed this episode, please make sure to hit that subscribe button and leave us a review. And in the comments, let us know what topics you want us to cover on upcoming episodes, and we'll make sure to get that in the books for you. And if you really want to learn how to launch, automate, and scale your short-term rental business, if you want to go deeper, then check out our free masterclass at strsecrets.com.